This is terrifying. I'm your host, Steve Metre, and thanks for joining me today. In our show today, a black swan event is about to devastate the U.S. economy, and I want you to understand that the government and political elites around the world are outright terrified. They know this is coming, and this is going to have massive political ramifications for those in power, to the extent that they're actually trying to engineer a whole nother separate crisis ahead of time to get policymakers to react in a big way. And when there is a crime and you need a reaction, security professionals are turning to our sponsor for today's show, Nightscope Inc. You can find them on the NASDAQ under the symbol KSCP. And the reason you want to look up their chart is it just formed a double bottom into a supply zone. The last time it did this, the stock rallied 47% in less than 2 weeks. I'll show you the chart setup. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now let's over to Bloomberg, because I want to understand what these political elites are trying to engineer ahead of time to stave off what is going to be a devastating global financial crisis, one that will bring the banks to their knees. And here we can see where the headline is: the U.S. dollar's extended reign delivers a stark wake-up call for the markets. And what this is suggesting is that investors have gone too far. They bought equity prices at extreme valuations, and the dollar is threatening to unwind this. But why do the political elites want to see the dollar rally here? Because it has a very simple fix, one that every major central bank, including the Federal Reserve, wants, and every politician at every level of the government around the world needs to see happen immediately, and that is to get the Fed to cut rates, and far sooner than they want to. And having entered the year predicting the greenback would decline as investors, well, they bet on the fact the Fed was going to cut rates. They've been forced to rethink this by a red-hot U.S. economy and sticky inflation, requiring the Federal Reserve to hold off cutting interest rates. And with the International Monetary Fund predicting output stateside will go twice the clip of the group of 7 peers, talk of U.S. exceptionalism is rife in supporting stocks and bond yields, adding to the dollar's appeal. Now, what's notable here is the idea that a strong economy here in the U.S. leads to a strong dollar. Well, that's not exactly how the dollar works. Remember, it's a global reserve currency. What we need to see is a strong dollar on the back of a strong global economy. The challenge is we're not exactly seeing the rest of the world show strength, which starts to beg the question is, why is the dollar strong here? And it could be simple. It just could be a time of mounting geopolitical strife. The currency still stands as the ultimate currency haven, but is it just the fact that we're seeing money drive into the dollar? Well, let's take a look at the relationship between the dollar and inflation. We're going to look at the consumer price index here against the Japanese yen to US dollar spot rate. The reason we're using that as a proxy for the dollar is simply because the St. Louis Fed database doesn't have a long history of the dollar in its database. And what we want to see here is there's virtually no relationship here. The idea that rising inflation, well, leads to a rapidly rising dollar or strong dollar, you can see that there's plenty of cases where the dollar is actually coming down against rising inflation. And if we were looking for a correlation here, well, we wouldn't find one at all. But that is kind of the view right now, is that the U.S. economy is strong, so there's demand for dollars, when it should be the global economy outside the U.S. economy is strong. That's where demand for dollars comes from. It's all throughout global trade. And here we can see the dollar index has gained more than 4% this year, reflecting advances against all major developed and emerging market counterparts. One popular gauge of trader sentiment pointed to a bearish at the start of the year, but has since flipped to become the most bullish since 2019. This according to data from the Commodities Future Trading Corporation, as speculators pile into long dollar positions. Now, why would political elites around the world want to see the dollar rally here, even though they know it's going to damage their own currencies and push them lower? It's real simple, because if the U.S. dollar can start choking out the growth of the U.S. economy, then everybody can be a winner here. The Fed can start cutting rates, and that gives some hope that will slow off or maybe starve off the big black swan event that is brewing right underneath the U.S. banking system in a major way, since nobody really wants to talk about it. And those recalibrating their strategies for the dollar is the world's second biggest money manager, Vanguard, which is now calling for sustained strength. The question is, do they understand why they're making this claim? Even UBS says the dollar's probably got further to rise. We'll make the case why it does, despite being 20% more expensive than typically valued, and that's causing major problems in the global economy. And Wells Fargo capitulated on forecasts for weaker by year end and now reckons it will extend its climb all the way into 2025, and this would be catastrophic. But the odds of that happening are low, because as the U.S. economy starts to fall under the weight of a strong dollar, again, it puts the Fed into a position of cutting. Here we can see really what's driving the dollar. In fact, it's a weakening global economy is one of the big reasons, because when the dollar actually gets stronger, it's because there isn't enough of them, and dollars are created through trade when banks lend to grease the wheels of international trade. Here you can see imports of goods and services is coming into the U.S. against the nominal broad dollar U.S. index. And what happens is when you see the year-on-year rate of change of imports decline and even contract, what happens? The dollar goes up. But notice then how imports start to rally, and what happens? The dollar weakens. It's all because as global trade expands, the dollar over long periods of time is naturally going to lose its value, because again, as trade expands, banks lend, and you see this relationship where the dollar gets stronger and trade declines each and every time, setting up the case that the dollar here is actually likely to go higher. This would be a really good move for the Fed that allows them to cut. But the bigger issue is even the Fed and the government here know, and it's not just the U.S. government, it's governments around the world, recognize there is a big, giant black swan event coming. It's getting here closer every day. They need to engineer some form of a crisis or catastrophe to get the Fed to cut now, because they're boxed into a corner. And if other countries can't match the growth and inflation of the U.S., there's just no other option than to buy the dollar. And what was a very tactical trade for us before has become much more of a long-term structural view regarding sustained dollar and U.S. economic strength. And much of that view comes from the fact, and we've noted this on the show, that there's no relationship to monetary policy in the dollar. What there is a relationship with is investors like to buy things that are high and rising because they think it's going to go higher. Most investors will tell you should buy low and sell high. In reality, you even see professionals buying high on the hopes that others chase it up. And the greenback's resurgence has come on the back of a slew of signs as the U.S. economy swerved the slowdown many anticipated. Well, we're not quite swerving out of this yet, as the labor market has stayed tight and manufacturing activity continues to expand, even though we're seeing weakness in the labor market from the manufacturing sector. The resulting persistence in inflation has led Fed Chair Powell and fellow policymakers to wait longer than expected to cut rates, which is again coming back to the market believes the Fed has control of the dollar, even though it doesn't. So as long as the Fed maintains its policy, that means everyone piles into the dollar until the U.S. economy starts to slow. Then, of course, that means the Fed can cut. But there's another factor here. It's not just global trade is having an impact on the dollar and the shortage of them. It's the fact that the banks aren't creating enough of them. And we can see that here at the net percentage of domestic banks tightening standards for commercial and industrial loans to firms of all sizes. That's shown in blue and shown on net tightening when it's above that horizontal black line. And look at this against the nominal broad dollar index. So what I want you to be thinking, if the bank isn't creating enough new money, which we can see by tightening lending standards, and we're not showing a chart, but commercial industrial loans, which I've shown on shows recently, is in contraction, meaning commercial banks are destroying money, then what we should see here is exactly what we do see, which is that when banks tighten lending standards, at some point the dollar rallies because there's a shortage of them. You see that here in the global financial crisis. You see that start to happen during, of course, 2015 through 2016 as the dollar rallied and then took screaming higher from there. You see it going to the pandemic as banks started to tighten, and you see it now. So what we have is a double problem for of the dollar. Not as global trade declining, but the banking system is actually destroying dollars and not in a position to create even more of them that we desperately need to weaken the dollar to cause the global economy to balance out. And here you can see the surge in the world's reserve currency inflicts a price on its counterparts and their economies, again threatening to break them, which would undermine the U.S. banking system. When we wait till you see what the black swan is, which traders are also scrambling to address. India and Nigeria are among the countries seeing their exchange rates plumb record lows, while threats of intervention are being heard from Japan to Poland. And central banks in developed markets such as Australia, the Euro area, and UK may find their room for lowering rates limited if weaker exchange rates fan domestic inflation, which will notably say they're not going to happen. And we'll show you that in a moment, as those countries are burdened by foreign debt, including the Maldives and Bolivia, as well as those heavily reliant on American imports, may be the most hurt. So what you're seeing here is around the world is everybody's seeing their economy slow down. They need to cut rates, but because the Fed has hitched their cart, this inflation story, and then the core inflation story, that they can't cut rates, even though we've shown in the past they do cut during times where inflation is not dropping as fast as they want. In fact, they even cut when inflation's rising. But is the rest of the world likely to see inflation here? Not at all. Because one big factor is we see imports of goods and services declining. That's coming into the U.S., still in contraction here below the zero bound. And you can see the relationship to the U.S. Consumer Price Index. The fact that we still see a contraction means the global economy is slowing. And if you're going to see a weaker currency outside the U.S. due to a strong dollar, that means manufacturing should be roaring in other countries. It's not. It's just a sign that their currencies are weakening and not going to lead to inflation, because there's a severe lack of global demand. And that's causing global and growing anxiety caused by the greenback's rapid ascent, which is why political elites around the world need to engineer a crisis ahead of time, because they know things are going to get really bad. And politically, it doesn't work well for many of them, especially those facing re-election, as a group of 7 nations earlier this month reaffirmed their common stance over the political damage of disorderly currency moves. This came after U.S. Treasury Secretary Janet Yellen acknowledged the concerns of Japan and South Korea over sharp declines of their currencies, which may offer Tokyo and Seoul more scope to defend the yen and won. And here you see the issue is all coming back to the global economy. As long as the U.S. economy is stronger than its G7 brethren, the dollar will be strong relative to other currencies. This from a University of California, Berkeley economist. Not everyone may be happy with this, that there is little that can be done about it. Oh, not so much. If you can engineer a crisis and get the Fed to cut, well, the next thing you know, you can actually do something about it, because the market will perceive the Fed cutting as weak dollar, and they will change their trades immediately. The problem the Fed faces in the government, all these political elites, is the Fed is boxed in. They can't move. And here you can see the Fed's preferred gauge of inflation, which we'll get this week, is set to back rate cut patience, as we'll look forward to getting the personal consumption expenditures data, which of course we know compared to the CPI is the Fed's preferred gauge. So why do they need to see the dollar break the U.S. economy and maybe not snap it in half, but really put the brakes on it? Well, they need the Fed to cut, because there's something brewing underneath the U.S. banking system, and not just here, but around the world. It's about to unleash the biggest black swan event we've seen since the global financial crisis. As office vacancy rate near now 20% to set fresh record, this according to Moody's, and vacancies rose a record 19.8%. This from, again, a Moody's report. That up from 19.6% in the fourth quarter of last year. Despite the increase, the firm said that early data points to a stable quarter for commercial real estate, which, of course, when you have that kind of vacancy, is not really stability. It's just more of how bad things really are. And tenants continue to downsize with the hybrid work model showing more staying power, battering the office sector. The Federal Reserve's interest rate hiking cycle has also wounded commercial real estate. The struggles in the sector have already sent vacancy rates past their historic peak set in 1986 and 1991, with the possibility room for more. And that is the danger. You've seen this black swan event brewing in the commercial real estate market. And if this starts to go, which we're seeing some early signs now that are getting worse. I'll show you that in a moment. You start to understand why the government needs the Fed to cut rates. The Fed knows this because the banks are still insolvent, and the problem is they can't cut. But what could you do? You could cause a currency crisis leveraging the dollar that everyone buys into. That's why these political elites around the world are doing very little to starve off the decline of their currencies, because if they can break the U.S. economy just a little bit, slow it down, put the brakes on, the Fed starts to cut, maybe everything normalizes and we keep the commercial real estate disaster from happening, as the evolution of offices is similar to what's happened with malls, where some thrive while others fails. Winners and losers will be determined by proximity to mixed-use neighborhoods and public parks instead of the typical office block. But they need something called time, because here you can see they just don't have it. As commercial real estate foreclosures soar to levels not seen in nearly a decade, as larger cracks are appearing in the commercial U.S. real estate market at a time when uncertainty around regional bank industry flashes red. Here we can see in the latest report from Adam, they show the CRE foreclosures topped 625 in March, up 6% from February, and up 117% from this time last year, suggesting that we are on the cusp from an event that nobody sees coming. This is the black swan that the government can't stop, but they can if they could create another crisis, get the Fed to cut, and maybe if commercial real estate unwinds a bit, then of course the Fed has all the leeway to slash rates as low as they need to, maybe even find a way to go negative. But if they can't do it, well, when this breaks, there goes the banks. And they've been tracking commercial foreclosures since 2014, and that peak is of 889 was set back in 2014. They're seeing a notable rise in California, New York, Florida, Texas, and even New Jersey. And regional banks are providing a bulk of the financing for the space, which suggests, as they are already insolvent, this means a banking crisis full on. You want to talk about panic in the markets and among savers, you'll have it. The ongoing mess of the lending space due to tighter conditions adds to pressure in the CRE downturn. Banks are expected to set aside more money to cover potential CRE losses, meaning they've got to buy bonds. When we've been identified that the banks have high commercial real estate concentrations, this from Fed Chair Jerome Powell, particularly office and retail and others that have been affected a lot. He said this is a problem we'll be working on for years. I'm sure there'll be bank failures, but not the big banks. He's right. The big banks aren't exposed here. But can you imagine if there is a domino effect to the regional banking system here in the U.S. and you start to get the picture of why they need to cut, why we need a currency crisis led by the dollar, and why everyone's moving behind it, because even Morgan Stanley warned the office prices could plunge 30% due to sliding demand. And you want to talk about an oversupply in offices, apartments? Well, that means the banks can't write down the loans. That means those who are holding the loans, they'll just walk away from the property, leave it to the banks. The banks don't have any leeway to deal with this at all. And for those wondering why the excess supply of office towers can't be converted into affordable housing, well, Goldman knows the prices have to drop 50% to that happen. And even then, if they dropped, it's going to take years to convert them. But it's not just the U.S. that's facing this. Here we see German office values to drop as much as 10% this year, and they're expecting declines across all real estate classes. In fact, 2024, the financial year, will definitely remain challenging for all players of the real estate market, as the crisis in real estate, fueled by multiple rate hikes, has hit commercial properties harder than homes, as sluggish economic growth and remote working trends mean demand for offices has remained subdued all of last year. And prices for commercial properties fell by 12.1% in the fourth quarter compared to that of the previous year, suggesting that indeed, you see why political elites are trying to engineer this currency crisis through the strong dollar to slow down the U.S. economy enough to get the Fed to start cutting rates, start to bring the global economy into parity, so maybe they can get growth back before this commercial real estate disaster turns into an all-out black swan event. But when security professionals have a crisis, there's one company they look to, and that's Nightscope. You can find them on the NASDAQ under symbol KSCP. I want to take a look at what's going on with their stock, because this is a tremendous opportunity, as you're going to see a double bottom and deep into a supply zone. Again, the last time this happened, in less than 2 weeks. I'll also show you the stock rallied an impressive 47%. And as we're recording, we're already seeing buyers step in at this level. Let's take a look, and you have to double check the charts, of course. Again, on the NASDAQ, on the symbol KSCP. And when you need superhuman capabilities to fight crime, well, that's why you've got Knightscope. And they are an autonomous security robot company who uses a unique combination of self-driving technology, robotics, artificial intelligence, and electric vehicles to provide humans with extra eyes, ears, and voice on the ground. They can be in multiple locations at the same time, helping you protect the places people live, work, study, and visit. As we talked about when they were sponsored recently, they've had a big purchase and demand from security professionals and security agencies looking to buy their products, setting up a potential big opportunity in their stock. Not to mention, I'll show you exactly where the shorts are at here and how they can be squeezed and see this stock again do what it did last time and rally an impressive 47% out of the supply zone. Here's the chart, and what you can see is the last time price came down here, this was in roughly the 40 to 42 cent range. What happened in the less than 2 weeks following, you can see it rallied through here, and then volume took off as it got through the supply zone. Why is that? Because the shorts got squeezed, sent the stock surging higher up here into the 60 to 62 cent range. That happened again. This would be a 47% gain. Here you can see the stock today dropping right down into the supply zone. And as we zoom in, now we didn't see this on the screenshot before we filmed, but I did look, and what you notice, buyers were already stepping in here because they know what happened last time, which was a tremendous opportunity to own the stock and see a large realized gain come out of this move. And you can see the short sellers right here as we zoom in to the 30-day chart. They sold and drove the stock right down here. You see a price rally into the 48-cent zone that will squeeze those shorts and then cause what we saw back here, the stock likely to go vertical up as much as potentially a 47% return. And that's for our sponsor today's show, Knightscope. You can again find them on the NASDAQ on the symbol KSCP. But as always with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.